So as I mentioned in my previous presentation, at our Oxford meeting, the topic of calculations came up, and a new idea was proposed, and we thought it'd be good to discuss it here. But before we get on to that, it's probably useful just to give a quick background of XBRL calculations, where we are today. And why do we have XBRL calculations? Well, in essence, financial reports really are just a series of calculations, and XBRL can help us understand them. So if you take a simple a typical financial report like Apple's latest 10K filing, you can start looking at numbers, and if you look at them in an inline XBRL viewer, you can actually start seeing the calculation. So if you click on the number at the bottom, the 364, you can see that that's the sum of the two numbers above it in green. You can click on one of the green numbers and it tells you that's the sum of the three numbers above that. And you can click on one of the individual numbers like the 74,000, or billion as it probably is, and find out where that number came from. If you're using XBRL software, it'll tell you that this fact appears in two places in the report, and you can jump across to the other place that figure appears in the report, and lo and behold, there's another calculation. So you can take advantage of XBRL information, XBRL calculations to better understand an XBRL report. XBRL calculations can also help us with consistency checking of XBRL reports, making sure they actually add up correctly. And here's an example of one of these calculations I showed earlier. Taking into account the stated accuracy, you can actually check whether these numbers are consistent or whether the preparer has made an error. So that's all very useful, and this is great, this is brilliant, but there's a but coming. Click on this number here, which is total net sales across Apple's different segments, and unfortunately that's a dimensional breakdown, and you click on that figure, very sad, there's no calculations, because calculations unfortunately can't do that at the moment. But they've got other limitations. The calculations are defined in a taxonomy, and then we check them against numbers in a report. How do we know where to check these? Which figures do we actually check? Well, a calculation gets checked anywhere you've got the total and at least one contributing item, which works pretty well in the most part, but quite often in financial reports, you get errors where you've got a total and one contributing item, but not actually got enough to fully check the calculation. And that leads to calculation inconsistency, false positives. There's nothing wrong, you just haven't reported enough data for the calculation to add up. So calculations is a feature that it came in the original XBRL 2.1 specification back in 2003. We've renamed that calculations 1.0 because it was confusing that 1.1 was the successor to XBRL 2.1. And in 2023, we released calculations 1.1, and that fixes a very important, significant class of errors that we were seeing with calculations 1.0, which is inconsistencies due to rounding errors. So that was a significant improvement, but it only fixes one part of the problems, and we've had this long-standing plan to do calculations 2.0, which is going to fix everything else. However, if you extrapolate this timeline, it's taken us 20 years to do a point release. Calculation 2.0 is going to fix everything else. Maybe that's another 20 years, but actually it's another 0.9 we've got to go. I don't really want to guess when that's going to be finished. But more seriously, we did get quite a long way down the path of exploring what calculations 2.0 would look like. But the short answer is it gets complicated really quickly. There's reasons we haven't tackled this, and it's actually quite hard to do. Tackling this completeness problem is difficult, and the approach we discussed when we discussed this in detail back in 2020 was associate calculations with sections. This calculation relates to the balance sheet. And then when you prepare your report, you've got to say this fact is a balance sheet fact, and you only check the balance sheet facts using the balance sheet calculations. But also dealing with the different types of calculations, the cross-dimensional calculations, the roll forwards, that gives you lots of different ways that you could calculate a number. You could infer a value to use in other calculations. But it gets very complicated very quickly, and I did start trying to build a prototype. It was really quite baffling. So at our Oxford meeting, someone, and we forget who, and they're not owning up to it anymore, I don't think, proposed a completely different approach. So rather than having the current approach, is to define the calculations in the taxonomy and you apply them to the report, you've got to guess where they're applicable, why not just relate the numbers themselves and say that number adds up to that one, that one's the sum of those ones over there. And I think everyone in the room pretty much went, no, you can't do that, that's a ridiculous idea because, and actually we couldn't come up with any obvious fatal flaws with it. So we thought, well, let's raise it here, let's discuss it here. Let's delve into some of the details of what this new fact-based approach of creating relationships in the report to relate new figures with mean. So, taxonomy-based calculations always felt like the right way to do it, but perhaps it's not pragmatic. So the obvious implications for fact-based calculations is that you need to repeat it for each period that they're applicable, rather than a single calculation that applies to both periods. You'd have to redefine it for the numbers in one column and then the numbers in the next. And you need to recreate them for each report, but actually with extension taxonomy, people are doing that largely anyway. But some problems obviously just go away. Incomplete calculations go away. If you don't have enough figures to create the calculation, you don't create to complete the calculation, you don't create it. And the different types of relationship are no longer a problem. If you've got a calculation that crosses different dimensional breakdowns, you just create links between the facts involved. So some problems just go away, but there must be some flaws with this approach, and that's what I'd like to discuss now. So if I can invite Owen, Alex, and Thomas to come up to the stage, and could we please grab a microphone?
A microphone is on the way.
We share one microphone. So, as I mentioned, calculations 1.1 has gone a long way to removing the inconsistencies that were very, very common in ESEF reports due to rounding errors. But to what extent are calculation inconsistencies still an issue? To what extent do they still occur in ESEF filings and inline XBRL filings, and what problems do they cause? Any volunteers to take that one?
Well, I think you explained already that everywhere where you use concepts in multiple tables and multiple sections, you run the risk of having a calculation that works pretty well for one table, but will give you a false positive for the other. And of course, you can always ignore inconsistencies. It's not an issue for submission, but you kind of get paralyzed with the inconsistencies or none, because you would forget to see the inconsistencies that are relevant if you get enough inconsistencies.
Thank you.
If you get enough inconsistencies that that are false positives.
Okay. Anything to add to that?
Yeah, considering that the calculation 1.1 is very new, so from a software vendor perspective, I cannot report about experiences that maybe the new or upcoming ESEF filings will run through. We need to wait for that. But related to the inconsistencies, considering that the ESEF filings just have 4 financial tables, only one of them which is a dimensional table, in my personal ranking and in what I observed in the market also, this is not the highest ranked problem, and maybe to report about what our customers did, so they got such false positives and whatsoever messages in the first year. They are somehow used to it. There maybe were some discussions with auditors, and in the next year, the report is very similar. So they are aware of that. They simply ignore it, and so we are kind of in a stable situations. But with the idea, I have very different other associations, not only related to consistencies. Maybe we could come to that later on.
Sure. Okay. So, in theory, this new fact-based approach should remove all remaining calculation inconsistencies, but there must be some problem with it. What would be the impact of adopting fact-based calculations on the preparation process? How would the process have to change there?
Well, I think the first thing, if we look before the preparation, we already need to make sure that we define how you can, what kind of relationships you can make. Otherwise, we run into the risk that you get a wild west of relationships being made, intentional or not intentional, where, for instance, you make a relationship in the balance sheet for one period and make a different one for the other period, which was unintentional maybe. And if we do not make definitions or if the preparer doesn't make, the taxonomy maker doesn't make that definitions, or we don't make specifications for it, how would we consistently validate those relationships being made? Next to that, when we go to the preparers of the files, obviously you can see that it's more work to make more specific relationships instead of using the calculations from the taxonomy. But for a large part, I think that software can help with that and automate a lot of these relationships based on the calculations that hopefully still in the taxonomy exists. Mm-hmm. And then you only have to extend with the ones that you want to add to prevent false positives. And if you want to even make more section-specific calculations to help your consumers.
Thomas?
Yeah. Maybe considering the impact that might be there for existing software, my first thought was, okay, the user interface does not even has to change, having in mind that the user in the past filing periods created the calculation rules. It can be done in the same way, and then somewhere when the report package is created, these report calculation relationships are simply generated. That only works if ESMA, for instance, is not requesting some additional rules. So this is just a guess that it might be that simple, but it might also become complicated if we cannot preserve that simple approach. That means that we create a calculation rule once for all periods. It does not end up with repeated work.
So of course, one of the issues of removing the obstacles to calculations is that you now open up a new world of calculations that need to be expressed. Roll forwards, people haven't worried about those. Now you have to deal with those across dimensions. Hopefully for ESEF it's only a few little breakdowns like that, but obviously in the US context it would be quite a lot in the notes. But these are all good things, I think, in many ways. There would be an opportunity to have much more understanding of what the reporter intended the numbers to collect, and I think analysts would find that information quite useful in general.
Yeah. Hopefully it would simplify the filing rules, because I know that the SEC currently requires you to create a calculation relationship for every fact except the ones that you can't do it for. And then that just becomes...
Which is always a bit interesting.
Yes. Every number must be covered by a calculation. Yeah. So one question that often comes up when we're talking about enhancements to calculations is XBRL formula can already check all this stuff. XBRL formula can check roll forwards, dimensional breakdowns. Why do we need calculations at all?
And I think we can cover that one very simply, which is your nice pretty diagram where you put up some numbers and highlighted the ones that didn't add up. And the pain a software developer would have to go through to have any chance of parsing XBRL formula and figuring out which things were actually involved in it sensibly, understanding what the calculate. In other words, both in formula and in Zool, you can express pretty much any relationship you want. Whether that is then usable in all the context, explainable to the end user, build software around it, is a totally different question. I think that you need to have some constraints on what can be done to give software developers a chance.
And I think I would like to add to that is, let's say issuers create their own formulas. Well, first of all, they need to figure out how that actually works. And even if the software can do it for them, then, especially for ESEF, for instance, auditors need to validate those formulas. So they need to learn XPath and need to figure out what the formula actually says and if it does what it should do. So, it's probably way too complex to leave to the specific issuers.
I can only add that would be a nightmare to our support because the issuers would simply not understand what is the technical meaning, and then there would be a ping pong between auditors and the software companies.
Okay, so not a popular solution. So one of the questions that I would like to hear answers on is in the current world, the base taxonomies, IFRS, US GAAP provide their own calculations, but preparers then provide their calculations for their report in the extension taxonomy. If we move to a fact-based approach, what role would the calculations in the base taxonomy play? Would we still have calculations in the base taxonomies? Any base taxonomy owners here?
Well, I hope so. I hope so, because it would make it way easier for software, for instance, to use it as a reference to automatically create the relationships that are definitely necessary. And it's also a way for auditors, for instance, to check if the relationships that the issuer made are actually make sense against the calculations that were created in the base taxonomy. So.
Yeah, I think we would definitely still have calculations or the expression of those relationships in the base taxonomy, because I think we've got two things going on. One is, what did the taxonomy author intend for these elements to relate? How did he intend these elements to relate? What are they supposed to be used? How are they supposed to connect to each other in a general sense, which you'll be right 98% of the time. And that's very important for people's understanding, I think, of the taxonomy and how things fit together and for users' use of the data. It's then, as you say, also the template that you start with to kind of propose things to an instance author who then goes, yeah, except for me on this occasion, this one and this one. And I think it's right to separate the two because, as we've established with calculations too, it gets complicated fast. It also butts up against the fundamentals of accounting, which is some of these relationships, everyone agrees on except. And software doesn't like except. So it maintains that flexibility to be able to have something that's consistent for the instance, to be able to have something that's expressive in terms of the relationships in the base taxonomy, which may be completely different specs, in fact. And then I think there's then the wonderful black box world of what the user suggests for their instance actually plausibly compatible with what the taxonomy suggests, which, as you say, it's an audit issue, which presumably for humans is trivial, and it's a sort of reception validation, which is something that standards is not, shouldn't be worrying about, and for people like Campbell developing validation software for receivers. I think that's a complicated problem, but not one that standards necessarily need to adapt. That's kind of where art and magic happens.
Yeah. I can only add maybe the perspective from analysts or some automated processing of the data, considering that XBL taxonomies are a contract between the preparers and the receivers. And now having, guessing what happens with removing the calculation rules, which is something very fundamental in reporting, that would mean that we remove one of the most important things from that contract or from the basic idea in my understanding of XBL. So, I think that's not a good idea.
So I guess a follow-up question to that is, existing calculation relationships are limited in their functionality, taxonomy-based ones. Do we still need some part of calculations 2.0 to improve the coverage to different calculation types, the cross-dimensional stuff? Because I think a lot of the problems go away if you no longer using them for validation. Do we still need to extend the capabilities of calculations for base taxonomy purposes?
Yes, absolutely. I think we do. I think just as it's useful to express the relationships between elements in the base taxonomy, those other features, the roll forwards, the dimensional aggregation, we do need to express. In fact, I was in an IASB board meeting a couple of days ago when I had to have a sort of awkward conversation with some of the board members who were starting to get a bit more interested in digital reporting and do these features carry across, and explain that yes, I know we've been using XBRL for 15 years, but it still can't add across a column.
Yeah, I can only agree. I think we should not see relationships as a change or as a replacement of calculations. It's rather an extension to the calculation. So anywhere we can improve the calculations is always a win, I think.
I can only agree to what was said before, but maybe adding a different perspective. If we think about, again, the taxonomy is a contract, so we have a common understanding of the calculations. They are not complete. It's clear that we need calculation too at some point in time. But from another perspective, maybe relating to the AI track we had yesterday, it also seems a good idea for all the individual semantics which is included in the reports to provide some utility to improve the accuracy of AI tools in the further processing. So I think both levels have their value.
Okay, thank you. And one final question from me, which is something of a bigger picture question, and perhaps not an entirely fair one. But to a newcomer to XBRL, you say, okay, we've got the base taxonomy, that models the accounting standard, and that tells you what concepts to use, and that tells you how those concepts add up. And so surely you take that taxonomy and you apply it to your report that conforms to that accounting standard, and you just validate it, right? Surely it's that simple. And of course, actually, in practice, it's not that simple. But the question I'm always wondering about is, to what extent are the issues that we see with calculations and the need to customize them in each report a consequence of the fact that we've got accounting standards that were designed for human readers, where it's not a problem if the reports are different from one company to the next, because it's always a human reading it, and that they were never designed for structured digital reporting, and to what extent are these problems derived out of preparers having too much freedom in how they prepare their reports?
Well, I think maybe that's looking at it in the opposite direction than that you should look at it, because a report is there to reflect on reality. So you try to make your report as close as to reality as possible, and auditors are, from our point, we try to make everything really comparable and have comparable data, but from an auditor's point of view, everything needs to be very accurate. And that makes sense, because data quality is also in its accuracy. So if a report is there to show reality as much as possible, and our taxonomy standards are there to model the report as realistic as possible, we should always look to change our models and change our standards to reflect reality better, instead of trying to change reality to the limitations of our models.
Yeah, so that's a very interesting topic, actually, because we have discussions for more than 15 years, I think, on such a topic. From the analyst perspective, I think the analysts would like to have as many calculation rules and a very strictly defined taxonomy, clearly, but from a legal perspective, for instance, it's often simply not possible to get rid of all the alternatives in reporting and all the uncertainties. And I think the IFRS taxonomy is a good example that you only have a few levels of calculations, and it's really difficult in practice to use such calculations. So now it's a good point to hand over to you.
Yeah, and I don't think it's a 15-year problem. I think this is a length of the accounting profession problem. This is a 100, 200, 300-year problem, because it's a fundamental tension as to what the accounting is for. Is it to describe a company well in a way that's useful and useful for an analyst looking at that particular company, or is it to make companies comparable with each other? And there's just a fundamental tension there that the more, the stricter the requirements are, the more fixed they are, the more comparable you may be across companies, but that information may be useless because it doesn't actually really describe any of them very well. Or you have something that's very flexible, allows lots of people to kind of tell the story, as accountants like to say, give you a nice description of an individual company, but now none of the information is comparable because everything's in a slightly different place to the next guy. And this is very definitively a question that's, the IFRS Foundation, the accounting standards, is above my pay grade. This is a board level conversation that happens every time. There's a constant tension in there. All we can do is accept the reality, which is there will, I think, always inevitably be enough flexibility in the accounting standards to stymie any attempt to have a, absolutely definitive one calculation model and nothing moves around, there's no variations.
So if we look at data quality, there are a couple of aspects that define data quality, and two of them are the one that's conflicting with each other, and that's the comparability and the accuracy, where as a data analyst you try to make everything as comparable as possible, but an auditor, for instance, wants to make it as accurate as possible, and that always clashes. But there is an answer, I think, and the answer is granularity. And with this solution of using both calculations and fact-to-fact relationships, that would give more granularity. So it would be a better solution to keep the both separated from each other instead of fighting.
And it's at this point that I have to introduce you to my board member, Zach Gast, who's very much on that side of the argument, saying technology, the ability to provide more data to people has changed this argument slightly. Maybe we provide lots of comparable data and sort of that you can work from at a low level, and then the sort of precise, appropriate to the company summaries of that. We don't no longer have to be worried about the fact that it's 2,000 pages worth of data. That's, the printed form is not a constraint anymore. An individual human reading through it is not a constraint anymore. As I say, this is a live ISP debate, and I can tell you that's not everyone's on the board's opinion.
But it does sound like there's a growing acknowledgement and recognition that the standard is used in a structured way, and that needs to support that. We are a bit late, aren't we? We've got time for one or two questions?
Time for one or two questions,
Yes, it's on. So it's more of a comment than a question, but you're not surprised. So, this has really been a struggle for all of us for a long time, and I just feel like, at least with the U.S. GAAP model, with the SEC model, we started in the wrong place. We started with a focus on granularity, and the granularity is important. It's what separates us from all of the other information that's available in the marketplace. But we threw away the normalized data set that a lot of people care about. And there's no reason we couldn't have done both and can't still do both. So my simple model for that is that, and I'm going to go to revenue as the example, which I've been using all day today. You tag revenue regardless of what kind of revenue it is, and then you use metadata to give you the granularity around revenue. It's not how we model today. We focus on the granularity, and with the SEC requirements, we tell you to tag the most granular item, and we might not even get a tag on revenue. And so we've thrown away the normalized data set that a lot of people legitimately want and would give you a baseline calculation. And we end up with a lot of useful granular information, but it's just not quite where, we've left out a very important part of the story.
I could add something to that. We've thrown away the granularity in what the filer submits, because the filer submits their own calculation link base, but we have as a reference the authority's calculation link base, which provides a higher granularity. So Paul, you used the word fact-based calculations. I think what we have for SEC filings are calculations that are only the facts that are reported, which is what Lewis is saying, but we have available in the authority calculation link base the higher levels of granularity. We use the authority calculations to make sure that people's filed calculations don't flip things, but we could also use them to infer the higher, the coarser granularity objects, because that information is there while processing, particularly in the Zulu environment, while processing the data. So we could presumably create those as in a BI sense, as the reported coarser granularity data.
Thank you. I think we will need to draw a line there. I know there were other questions, so I would encourage you to come and ask us after the session if you want to discuss it further. I'm sorry we haven't got any more time. Please join me in thanking our panel of experts on this topic. Thank you.